Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Thursday, November 6, 2008. The number of people employed in New Zealand increased 0.1% on a quarterly basis in the third quarter. But as more people entered the labor force, the number of people unemployed rose 6.3%, bringing the unemployment rate up to 4.2%. The increase in employment was better than expected, and economists had predicted that the unemployment rate would climb even higher. Still, with the global economy heading for a major contraction and commodity prices falling, New Zealand exporters will face tougher times ahead, limiting job growth in that important sector. The Australian economy added 34.3 thousand jobs in October, which kept the unemployment rate unchanged at 4.3%. Both figures beat economists' forecast as the number of new part-time jobs overshadowed the 9,000 full-time jobs that were lost. Still, just as in New Zealand, slowing global growth and weaker demand for commodities will hurt employment going forward in the key export sector, while the rest of the Australian economy copes with its own slowdown. Both the Aussie and Kiwi fell against the US dollar as the risk aversion swept up market sentiments again as global stocks fell today. From its level around 0.70 yesterday, the Aussie US dollar pair was down 340 pips by 3:30 p.m. Eastern. German manufacturing orders fell by 8% in September, the largest drop since 1991. The report darkens the mood over industrial production. Lower orders for big-ticket items and investment goods means companies have cut back on large purchases and capital goods in anticipation of leaner economic times ahead. Also, foreign orders slumped by 11.4% as the economies around the world suffer contractions and companies place fewer orders. UK housing prices were down 2.2% in October, accelerating the pace of monthly price declines. On a quarterly year-on-year basis, prices were down 13.7%, which is the largest fall in the index since its inception in 1983. The Bank of England took drastic action today and slashed its benchmark interest rate by 150 basis points or 1.5%, taking the rate from 4.50% to 3.0%. The economy is facing a potentially severe and long-lasting economic contraction, and with the bank's inflation fears easing, they took bold action to try and free up lending. Such a big move should give banks the chance to pass on a noticeable amount of the cut to their consumers, hopefully helping to unfreeze lending. The pound-yen pair fell in New York trading after a volatile candle right in the aftermath of the release. The pair has slid 800 pips from its high yesterday when the pair ran up against its recent line of resistance. Today, the pair broke below support at the 154 level, putting the pair at a 7-session low. The ECB cut interest rates by 50 basis points to 3.25% from 3.75%, which followed another 50 basis point reduction in October. Policymakers see inflation pressures easing and feel with the Eurozone economy and the global economy slowing that lowering borrowing costs is one way to stimulate growth. The ECB will most likely continue cutting rates, bringing the rate down to 2.25% by April. The ECB, which had been focused on inflation prior to the eruption of the credit crisis in September, is now focusing on the risks to growth. Economic growth is expected to be just 0.1% this year, said the European Commission, and growth in the third and fourth quarters are expected to be negative. The euro-dollar pair fell in favor of the greenback as ECB President Trichet said the economy has weakened significantly during his press conference. The pair has now dropped 350 pips from its intraday high yesterday around 1.31. With Trichet opening the door for more rate cuts ahead, traders sold the euro. The Swiss National Bank joined in the rate-cutting act as well, lowering rates 50 basis points in a surprise unscheduled move. That brings the rate down to 2% as the impact of the global economic outlook forced policymakers to lower borrowing costs. Also cited was easing inflation as a result of the fall in oil prices. The dollar-Swiss franc pair rose in favor of the greenback in the wake of the announcement, which helped the pair continue a rally it started at the beginning of today's global session. From its low near 1.1570, the pair climbed more than 200 pips and was close to testing key resistance set on Tuesday around 1.18. In the U.S., the number of Americans filing new claims for unemployment was at 481,000, a small move down from the upwardly revised levels seen the week prior. Continuing claims edged up further to 3.84 million, which was the highest level in 25 years. The employment situation continues to weaken in the U.S., and tomorrow's non-farm payroll report is expected to show the economy shedding another 200,000 jobs in October. Continuing in the labor market, productivity for the third quarter rose at a 1.1% annual rate, while labor costs grew 3.6%. As sales grow, companies are redoubling their efforts to protect their profits by cutting staff and workers' hours in order to boost productivity. In Canada, the IVPMI, a measure of business spending, showed firms increasing spending in October, but by a smaller degree than in September and what was forecast by economists. The PMI registered a 52.5 reading. With risk aversion on the increase, oil prices retreated back to the $60 a barrel level. The US dollar-Canadian dollar pair surged as a result, climbing 300 pips in New York trading following its intraday low near 1.1615. Stocks in the U.S. fell sharply throughout the day as the weak U.S. jobless claims report increased fear of even weaker non-farm payroll report tomorrow. Tonight, the U.K. posts its construction PMI. Overnight, Switzerland releases its unemployment rate while Germany reveals data on trade and industrial production. Tomorrow, Canada releases its employment report and the U.S. reveals its non-farm employment change, pending home sales, and its change in wholesale inventories. And that wraps up today's broadcast. Thank you for joining us here at CMSFX.com, and happy trading.